Welcome to the Deep Dive, where we take a stack of information earnings calls, research, market analysis, and, well, we try to pull out the most important nuggets you need to stay informed. Today, we're digging into the Q2 2025 earnings call for 22nd Century Group. They trade as X2. The call was back on August 14th, 2025. This is a company taking let's say, an intriguing path in the tobacco world and their latest results.
Yeah, they definitely got people talking. So let's just jump right into the numbers, the headline figures. 22nd Century Group reported a GAAP EPS of negative $13.16 for Q2 2025. That was a pretty big miss compared to the consensus estimate, which was around negative $0.27.
A very stark miss, yeah. And revenue wasn't exactly stellar either. Came in at $4.08 million. The consensus was looking for something closer to $5.44 million. And maybe even more telling, that's a huge drop year over year, almost 49% down from Q2 2024.
Oof.
Yeah. And you saw the market react pretty much immediately. A lot of skepticism baked in right away. Okay, so big misses. Revenue down hard. That's the top line story. But, sometimes the details tell a different tale. Was there anything less bleak deeper down, maybe on the balance sheet or operationally?
Well, you have to look closely. The top line numbers were, let's face it, challenging, but they did manage to keep their gross profit, or rather gross loss, pretty much flat compared to the last quarter, around negative $0.6 million. Operating loss was negative $3.0 million. Net loss from continuing ops, negative $3.3 million. Their adjusted EBITDA loss did widen a bit, actually. Went from negative $2.3 million in Q1 up to negative $2.6 million this quarter.
Okay, so still losing money.
Still losing money, yes. Yeah. Then they also brought in about $770,000 cash from selling off those Needle Rock Farms assets. So, yeah, operations are tough, but they are actively managing the finances, not just letting things slide.
Right. So a bit of a mixed bag, maybe. But those top-line figures are hard to ignore. Now, here's something that caught my eye, and it feels a bit strange. They actually sold more cartons this quarter, like significantly more. But revenue plummeted and the losses continued. How does that work? More volume, less money.
That's the key paradox here, isn't it? It seems counterintuitive. So total cartons sold jumped way up 779,000 in Q2 compared to 478,000 in Q1. Huge increase.
Right.
But the reason for that increase was almost entirely down to their contract manufacturing organization business, CMO. And these are high volume but very, very low price cigarettes. We're talking razor thin margins, sometimes even negative gross margins.
Oh, okay. So they're selling more units but losing money or making almost nothing on each one.
Pretty much. It boosts the volume numbers, looks busy, but it drags down profitability. It explains why the gross loss stayed stubbornly negative, even with all those extra cartons going out the door. It's like running faster just to stay in the same unprofitable place. Classic volume trap.
Okay, that makes sense now. So selling more stuff, but digging a deeper hole financially with it. Clearly, that can't be the long-term play. What's management saying? How are they planning to pivot out of this unprofitable volume game?
Exactly. And they were very explicit about this on the call. This isn't just tinkering around the edges. It's a major strategic shift. CEO Larry Firestone basically laid it out. They are moving away from being primarily a contract manufacturer. The focus now is entirely on becoming a niche branded company with higher margins.
And that means focusing
on their proprietary VLN products, the reduced nicotine cigarettes. They're framing the whole company now as a tobacco harm reduction company. It's a fundamental change in identity, really.
Tobacco harm reduction.
Yeah.
That's a bold claim in this industry. Tell me more about VLN. What's the core idea and how does it fit or maybe not fit with the rest of the tobacco landscape?
So VLN stands for very low nicotine. The whole idea is to tackle nicotine addiction head on. Management really emphasized this point, calling nicotine addiction a public health crisis. Firestone mentioned, the government warnings about nicotine going back to the 50s, and he threw out a staggering number, over $600 billion spent just on smoking-related illnesses in the U.S. back in 2018.
Wow. $600 billion?
And he suggested it's probably much higher now. So VLN cigarettes are designed with 95% less nicotine, less than 0.7 milligrams per gram. And here's the kicker. This makes them, according to the company, the first and only FDA-authorized product that meets the FDA's proposed new standard for nicotine content.
The only one. That sounds like a huge deal regulation-wise.
It potentially is. It gives them a unique position if that FDA standard becomes mandatory.
Okay, so they have this unique FDA-authorized product. But having a product and selling it are two different things.
Yeah.
What progress are they actually making getting VLN onto shelves and into smokers' hands?
They're definitely making moves. Just this August, their Pinnacle VLN brand started shipping. We're talking nearly 1,000 stores of a top 5 convenience store chain. Initial orders were over 3,000 cartons.
Okay, that's significant distribution.
Yeah, and they're planning a soft launch in early September, full launch in October. Then the smoker-friendly VLN brand is supposed to follow, and eventually their own 22nd Century branded VLN into another big retailer. Plus, they've been getting state authorizations sorted out. VLN direct products are now cleared in 44 states, partner brands in 30, smoker-friendly in 46, Pinnacle in 39. So it's a broad rollout strategy.
Seems like a lot of logistical work. What about keeping that regulatory edge? Are they developing new versions, ensuring they stay ahead with the FDA?
Good question. They're not standing still. They're working on a 100-millimeter version of the VLN cigarette, like a longer version.
Right.
The plan is to submit that prototype to the FDA in Q4 this year, 2025. And maybe even more critical, they're actively working on renewing their MRTP authorization. That's the modified risk tobacco product status.
When did that up?
They're targeting December 2026 for that renewal, and management sounded pretty confident about it. Their argument is basically, our product already meets the FDA's proposed standard, so renewal should be straightforward. It really aligns with where the FDA seems to be heading.
Okay, so this whole pivot, focusing on VLN, scaling distribution, it all sounds expensive, especially when they're still losing money, as you mentioned. So let's talk brass tacks, profitability. When do they expect to actually make money, and how are they managing the cash flow to survive until then?
Right. The crucial question, they've adjusted their timeline slightly. They now expect to hit profitability sometime in Q1 or maybe Q2 of 2026.
So early 2026. That's a bit later than they thought before.
It is. A slight delay. Management put it down to, quote, latent barriers, and things just taking a bit longer than hoped with scaling up the branded side, getting consumers on board.
Understandable hurdles, I suppose. And the balance sheet. How are they funding this bridge period?
Well, like we said, they cut debt by $1 million in Q2. They got that cash from the asset sale. The CFO, Dan Otto, mentioned they're talking to their lender about the debt that's coming due in March 2026. The plan seems to be, ideally, pay it down with positive cash flow once they hit profitability, but they acknowledge they might need a, quote, smaller capital raise if necessary. They're keeping options open.
Okay, so managing the debt is key.
Yeah.
And speaking of needing cash, isn't there a big potential windfall hanging out there? That lawsuit.
Absolutely. That's a really important piece of the near-term puzzle. They have a trial date set for November 2025. It's against Dorchester Insurance Company, and they're seeking $9 million for business interruption damages.
$9 million. That would certainly help.
It would be huge. A win there would mean a significant cash injection, and importantly, it would involve issuing more stock and diluting existing shareholders. It could definitely ease those financing pressures quite a bit. So November is a key date to watch.
Okay. Stepping back a bit, how does 22nd Century see the big picture, the whole tobacco market, the harm reduction trend? Where does VLN fit in their view?
They sort of map out the harm reduction landscape into 4 main lanes. You've got pouches and moist snuff like Zyn and Copenhagen, then heat not burn products like IQOS, then low nicotine combustibles, that's where they put VLN, and finally just standard high nicotine cigarettes.
Okay.
Their argument is that VLN competes directly with heat not burn for smokers looking to switch from regular cigarettes. And they position VLN as, frankly, a better option because it tackles the nicotine addiction itself. They kind of dismiss heat not burn and other options as just switching delivery methods, to plastic battery operated devices while keeping the user hooked on nicotine.
So their pitch is, we address the addiction, not just the delivery system.
That's the core message, yes.
Yeah.
They argue other harm reduction products mostly just maintain the addiction.
Right. So you have management sounding, well, pretty bullish, really, talking about a new beginning, very optimistic about the VLN strategy and the FDA tailwind. But the market reaction, as you said, was sharp and negative on the Q2 results. Why the disconnect? How can management be so positive when the numbers look so rough?
It's that classic tension, isn't it? Management's looking at the horizon, focusing on the long-term strategic pivot, the unique regulatory angle with VLN, the potential market disruption. They're telling a future story.
Right, the long game.
Exactly. The market, or at least the part of the market reacting immediately, like the sell-side analysts, they're often focused much more on the here and now. They saw the GAAP EPS miss, the revenue miss, the pushed-out profitability timeline, and they reacted to that. So investors seem to be weighing the current financial performance and execution risk more heavily than the potential future payoff from the strategic shift. Bridging that credibility gap takes time and demonstrated progress.
Okay, so what are the biggest hurdles they need to clear to convince the market? And conversely, what are the biggest opportunities that could really change the narrative? What should people watching this company be focused on?
The challenges are pretty clear. First, execution on distribution. Can they actually get VLN scaled effectively into all these stores? Second, consumer adoption. Will smokers actually switch to and stick with a very low nicotine cigarette? That's a big behavioral question. And third, cash management. Can they manage their burn rate and balance sheet until they reach profitability, especially with the timeline pushed back a bit?
Those are significant risks. And the opportunity.
The opportunity is almost entirely centered on the regulation. That proposed FDA low nicotine standard. If that becomes law, 22nd Century is, as they keep emphasizing, the only company right now with an FDA-authorized combustible product that meets it.
That's a powerful position.
Potentially a massive advantage. It could reshape the whole combustible market in their favor. It's a high-risk, potentially high-reward bet on that regulatory outcome.
So looking ahead, what are the specific things, the catalysts that could swing the pendulum one way or the other for XXII? What milestones should we be tracking?
Okay, key things to watch. Q4 2025, that's the target for submitting the 100 millimeter VLN prototype to the FDA. Then looking further out, December 2026 for that crucial MRTP renewal, that's a big one. Nearer term, just continued updates on the VLN rollout. Are they hitting those convenience store targets? Are partner brands launching?
Right, the execution proof.
Exactly. And don't forget, March 2026, that's when the debt matures. How do they handle that refinancing or repayment? And of course, the outcome of that Dorchester lawsuit in November 2025. That $9 million could make a real difference to their runway. It's definitely a company in flux, trying to leverage a unique regulatory spot into a profitable, maybe even purpose-driven future. Lots to keep an eye on.
Okay, perfect transition. It's time for our This Is Not Financial Advice segment. This is where we toss out a trade idea, maybe a bit wild, maybe plausible, inspired by the call. And I have to stress, this is purely for discussion, maybe entertainment, definitely not investment advice. Do your own homework, folks.
All right. So, considering everything we've discussed, 22nd Century's unique spot, management's bullishness versus the market's current doubt, here's an idea. How about this? A long position in XXII, financed by going short a major traditional tobacco player, one that's heavily reliant on the old school high nicotine cigarettes.
Okay, long XXII, short big tobacco. Let's break that down. What's the outrageous part?
The outrageous part is going long XXII right now. The stock's taken a hit, they missed earnings badly, profitability is delayed. You need real conviction to buy into this story today against the grain. It feels contrarian, to say the least.
Fair point. So what makes it plausible?
The plausibility hinges almost entirely on that FDA low nicotine mandate. If that happens, it's an earthquake for the industry. And XDTs is literally the only company ready with an FDA-authorized combustible product. The only one.
That regulatory mode again.
Exactly. Plus, you have potential catalysts. The MRTP renewal they seem confident about, the continued VLN rollout, the new 100 millimeter product submission. And if they win that $9 million lawsuit, that significantly de-risks the immediate financial picture, takes away some of the pressure.
Okay, and the short leg. Why short traditional tobacco?
The short leg acts as both a hedge and a way to play the broader theme. If the FDA mandate does become law, the big traditional players, the ones without a compliant low-nicotine combustible, face massive disruption. Their core product could suddenly be non-compliant or face immense pressure. 22nd Century, theoretically, gains share almost by default in that scenario. So the trade is basically a bet that regulatory change will create this huge asymmetric advantage for XT2, making their current operational struggles less relevant in the long run, while simultaneously hitting the incumbents hard.
A bold bet on regulation, completely changing the game. Interesting. Okay, that wraps up our deep dive into 22nd Century Group's Q2 2025 earnings call. Quite a story, really. A company trying to completely reinvent itself, moving away from low-margin contract work to try and lead what they call the tobacco harm reduction movement with this unique VLN product.
Yeah, and the path ahead, especially getting to profitability by early COM26, really depends on nailing that distribution scale up and getting smokers to actually buy into the low nicotine concept. But you can't ignore those potential regulatory tailwinds. The FDA angle gives them a competitive edge that's, well, pretty unique in the industry right now.
Definitely one to watch. Now, just a reminder, everything we've discussed here on the deep dive is for informational purposes only. It is absolutely not financial advice. Please always do your own research before making any investment decisions. We'd actually love to hear what you think. What stood out to you from 22nd Century's call? What's your take on this big pivot they're attempting? Let us know. Thanks for tuning in to the deep dive. We'll catch you next time for another earnings analysis.